Welcome to this deep dive. Today we're tackling a really interesting angle on navigating economic uncertainty. Specifically this question, what recession? I'm swimming in dividends.
Yeah, it's quite a title.
It is. It's based on an article offering this, well, seemingly upside-down perspective.
Right. How to not just sort of survive a potential recession, but maybe even find solid footing.
Exactly. Through dividend-paying stocks.
Precisely. This piece, it really flips the script on the usual recession anxiety. It suggests a strategy centered on companies returning cash directly to shareholders.
Like actual cash in your account.
Yep. The underlying idea is while many investors might be bracing for impact, others are seeing, a bedrock of stability, maybe even opportunity in these dividend payouts.
So our mission here in this deep dive is to really unpack the thinking behind this dividend focus.
Look into the nuts and bolts of it.
Yeah, we want to understand the potential upsides, but also, importantly, the pitfalls, which the article does mention.
The strategy is perfect, right?
For sure. Ultimately, we want to give you, the listener, the insights to decide if this strategy, or parts of it, might make sense for your own financial picture.
Because we know all this talk of downturns can be unsettling.
Definitely. So consider this us just equipping you with a different lens, a different way to maybe look at things.
Okay, so where do we start? The reframing seems key.
I think so. What's fascinating right off the bat is how this article reframes our typical reaction to just the word recession.
Yeah, it acknowledges the concern, absolutely, but then it quickly pivots.
Pivots to this idea that, look, a recession doesn't have to be this universal financial crisis for everyone.
Especially depending on how your investments are set up.
Okay, let's unpack that. The article draws a really sharp contrast, doesn't it?
It does.
Suggesting that someone heavily invested in, say, high-growth tech or maybe volatile crypto.
They might feel a real squeeze.
Yeah, the article uses this image of snorkeling in a sea of red. That kind of sticks with you.
It does. And then the author suggests that for dividend investors, a recession might be more like, well, what was the analogy?
The slightly awkward but ultimately familiar uncle at Thanksgiving.
Right. Maybe not thrilling, but not necessarily cause for panic.
Especially if your strategy is built for periods like that.
Okay, so that leads us nicely into the core, the appeal of dividends themselves.
Let's get fundamental for a sec. For anyone listening who's maybe newer to this, what is a dividend, really?
Simply put, it's a cash payment. A company makes it to its shareholders, usually regularly.
Okay.
Think of it like a slice of the company's profits being handed back directly to the owners.
And the article emphasizes that the company's doing this consistently. They tend to be pretty solid financially.
Generally, yes. Reliable profits, healthy balance sheets, those are usually prerequisites for sustainable dividends.
Right. Now, here's where I think it gets really interesting. The article points out that some of these robust companies actually increase their dividends, even when the economy is looking shaky.
Yeah, that seems counterintuitive at first glance, doesn't it?
It really does. What gives them the strength to do that?
Well, it points to a couple of things, I think. First, maybe a resilient business model. Think essential goods, things people buy regardless.
Okay, like staples.
Exactly. Second, it signals management's confidence. They believe profits and cash flow will continue.
And for the investor.
Well, like the article says, it means a dependable income stream. Money landing in your account pretty much regardless of daily market swings.
It's tangible, not just numbers on a screen going up or down.
Precisely. It's a real return.
Okay, now the article introduces this concept, DGI, dividend growth investing, calls it the secret sauce.
Right.
What's the key difference between just buying any old dividend stock and this DGI approach?
That's a really crucial distinction. So any dividend stock gives you some income, right?
Yeah.
But DGI is more forward-looking. It's about building a portfolio specifically of companies that not only pay now, but have a long, consistent history of increasing those payouts.
Ah, the growth part.
Exactly. The focus shifts. It's not just about the highest yield today, but about the growth and reliability of that income stream over the long haul.
The article uses some big names as examples. The Dividend Aristocrats.
Coca-Cola, Johnson & Johnson.
PepsiCo, Procter & Gamble. These are household names.
And they've managed to increase dividends for decades. Through recessions, wars, pandemics, you name it.
What makes that track record so significant for this strategy?
Well, these examples just showcase the potential for long-term stability and return that DGI targets. I mean, becoming an aristocrat isn't easy.
Right, there are rules.
Yeah, you need to be in the S&P 500, have 25-plus consecutive years of dividend increases.
Wow, 25 years straight.
plus size and liquidity rules. It points to serious financial discipline. And crucially, the article talks about reinvesting those dividends.
Yes, the compound interest myth.
Yeah.
Einstein's eighth wonder of the world.
Exactly. Reinvesting those payments can seriously speed up wealth building over time. It's that snowball effect. Your earnings start making their own earnings.
So as your dividend income grows, you buy more shares.
Which generate more dividends, and so on.
Powerful stuff. Now, the author does tackle a perception issue, doesn't he? The idea that this strategy might seem a bit...
Bit boring.
Yeah, exactly. Compared to chasing the next big thing, the next high flyer or meme stock.
Right, might not feel as thrilling.
But the counter-argument...
As the article puts it quite nicely, boring pays the bills.
I like that.
The focus here is consistency. Reliable returns that help you hit real financial goals, like buying assets, maybe retiring early.
Less about the adrenaline, more about the results.
Precisely. It's about building something solid.
And the article gives a hypothetical example to show the math behind this boring approach. Can you walk us through that?
Sure. It lays out a scenario.
Yeah.
Say you have a $500,000 portfolio.
Okay.
And it yields 4% in dividends initially. That's $20,000 a year in income.
Right.
Now, if those dividends grow at, say, a modest 5% per year, within 10 years, that income stream could grow to over $32,500.
Sure. And that's without adding any new money yourself.
That's the key point in the example, yeah. It just highlights the potential for that passive income stream to actually grow over time.
It really paints a picture of building financial resilience, doesn't it?
I think so. Instead of just watching your total portfolio value bounce around.
You have this income stream potentially growing, providing a buffer.
A sense of stability.
Yeah.
And the article even shares some specific stocks from the author's own portfolio.
Oh, right. That was interesting. Any standouts or reasoning that caught your eye?
Well, the selections give a real tangible feel for it. Realty Income, ticker O.
The monthly dividend company.
Yep, presented like getting regular rent checks. Very predictable income.
Makes sense.
Then you had consumer staples like Pepsi, PEP, and the healthcare giant Johnson & Johnson, J&J. Businesses with pretty enduring demand.
Things people need.
Right. Brookfield Infrastructure, BIP, adding diversification into essential assets. And ABV, ABBV, bringing in pharma potential growth and income.
So a mix, but all seem pretty established.
Generally, yes. Well-established businesses, history of returning value via dividends. That seems to be the common thread.
And the author stresses this portfolio wasn't random. It was built specifically with potential downturns in mind.
Yeah, a real-world illustration of the strategy.
Okay, but there's a warning label too. The article talks about the yield trap.
Ah, yes. Very important point.
What's the danger there? What is the yield trap?
It's a crucial warning. Just chasing the absolute highest dividend yields you can find, that can be really risky.
Why is that? High yield sounds good.
Well, the author uses a great analogy. Gas station sushi.
Okay, I get the picture.
It might seem appealingly cheap or high-yielding, but the underlying quality could be questionable, could lead to unpleasantness.
So a super high yield might actually be a red flag.
It could be. It might mean the company's in trouble, or the stock price has tanked, which mathematically pushes the yield percentage up, or the payout ratio is just unsustainable.
Meaning they're paying out too much of their earnings.
Exactly. And those super generous dividends, they're often the first thing cut when a company hits rough waters.
Which completely defeats the purpose of buying it for the dividend.
Totally undermines the strategy. So it's not just about the size of the dividend check.
Right. It's about the health of the company behind the check.
You got it. The article stresses looking deeper, check the payout ratio, look at earnings trends, the quality of management. Is this dividend likely to continue and maybe even grow?
Sustainability is key.
That's the word. A healthy growing dividend usually comes from a healthy growing business.
Okay, that makes sense. Then the article lays out some dividend recession rules, kind of actionable steps.
Yeah, some practical guidelines.
What are the big ones?
Well, number one is probably good advice anytime things get shaky. Don't panic.
Easier said than done sometimes, but crucial.
Right. Stick to your long-term plan if you've built a quality portfolio. And related to that, don't sell good stocks just because of fear. Avoid impulse decisions.
Don't sell the farm, as it says.
Exactly. And another key one, reinvest dividends if you can.
Seeing downturns as buying opportunities.
Precisely. Buy more quality shares potentially cheaper, boosting your future income. It also repeats the yield trap warning, don't buy junk just for yield.
And track your income.
Yeah, track the actual dividend income hitting your account. It can be motivating keep you focused when the market's volatile.
Interesting. Beyond the numbers, though, the article mentions a psychological benefit.
Yeah, this is often overlooked, I think, but really significant.
Especially when markets are turbulent.
Absolutely. During those times, seeing those regular dividend payments arrive, it can provide a real sense of stability, reassurance.
Like the article says, the hand on your shoulder saying, it's okay, you're still getting paid.
That's a great line. That consistent income can help you stay disciplined, keep that long-term view, and resist making emotional mistakes.
It's like panic selling at the bottom.
Exactly, which can be so damaging.
Now, the article does acknowledge some criticisms you sometimes hear about dividend investing.
Right, that doesn't shy away from them.
Like the idea that it's maybe just for boomers, older investors.
Or that focusing on dividends might mean you underperform the overall market, especially in strong bull runs.
What's the counter-argument presented?
It's quite pragmatic, really. The author argues that for many people, the main goal isn't necessarily beating the market every single year.
Okay.
It's more about achieving financial independence, security, generating reliable cash flow to cover expenses, maybe exceed them.
So shifting the focus from just maximizing paper gains
to prioritizing consistent, tangible income you can actually use, beating your personal expenses, not just some index.
That's a different way to frame success.
It is. And it leads into that final point about the joy of passive income.
Yeah, the article really paints a picture there. Getting dividend notifications. Basically earning money without actively working for it at that moment.
Right. Building an income stream that isn't directly tied to your time or your job.
Like the example of getting a dividend alert while still in your pajamas.
Yeah. That's the core appeal for many, isn't it? That potential for income while you sleep or travel or just live life. A degree of financial freedom.
Flexibility is attractive.
Very.
Okay, so let's try and wrap this up. This deep dive into what recession, I'm swimming in dividends. It's really explored this perspective that a well-planned dividend strategy.
Particularly one focused on growth.
Right. Dividend growth can offer significant stability and a reliable income stream, even when the economic outlook feels uncertain.
Yeah, it presents a potential path through volatility. But it's crucial for you, our listener, to remember this is just one approach.
Yeah.
Based on one source.
Absolutely. We really encourage you to think carefully about how these ideas fit with your specific situation, your goals, your comfort level with risk.
It's not a one-size-fits-all solution.
Definitely not. And on that note, we'll leave you with what the article playfully calls its 3-word cheat code for maybe finding a bit more financial peace.
Which is?
By quality dividends.
Simple.
Yeah.
Direct. Kind of sums up the core message, doesn't it?
Yeah, it does. A concise takeaway.
And maybe, like the author suggests, it prompts you to consider, so what recession? Perhaps exploring this approach further as you navigate your own financial path.